You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor series with Jerry Parker and I, Niels Kostrup-Larsen, where we do our best to bring you into the world of rules-based investing by sharing our knowledge and hard-learned lessons over the past few decades, hoping that you can avoid making some of the mistakes that we did. If this is the first time you're tuning in, welcome. It's great to have you here, and we look forward to our journey together. Moritz is unfortunately unable to join us today, but he will be back next week. So let me start, as usual, by saying good afternoon to you, Jerry. How are you doing?
Doing well, thank you. How are you? It's
yes.
First time I've ever been able to say good afternoon because we're recording in the afternoon in Eastern time. So I miss Moritz, but hopefully next week.
Absolutely. We need to fix his technical issues for sure before next week. I want to start out just giving a big shout out to Spy Surfer, who jumped into the Canadian iTunes store this week and left a very nice rating and review. We highly appreciate this, which I'm sure you have already heard me say. But also I want to give a shout out to everyone else who took time to leave a rating and review in their local iTunes store. I don't check all of them, so I kind of follow the US and Canadian one in particular. So appreciate that. And by the way, if you want to leave us a rating review, which we of course would appreciate as it supports the podcast in a great way, there are instructions how to do that. If you go to toptradersunplugged.com/review, and as something brand new, literally just installed that in the last few minutes before going on air today. We're going to try and also take maybe some of your comments, not necessarily questions to begin with, but if you have some comments for us that you want to try and leave on a voicemail, you can do that now. If you go to toptradersunplugged.com/voicemail, and we'll do our very best to play them, if they're nice, of course, on the show each week. So toptradersunplugged.com/voicemail. I hope it works. We literally just set it up a few minutes ago. Let's jump into this week's kind of review of the markets. An eventful week, to say the least. U.S. stocks losing ground every day of the week as we saw investors sought refuge in the fixed income markets, in gold and in the yen. Of course, I'm sure many investors after a week like this are asking themselves, what does these words the Fed came out with mid-cycle correction really mean? Or adjustment, I think he used. Of course, that creates a lot of uncertainty. Of course, a lot of the old thinking has been to buy on the expectation of the US Fed cutting rates. The thinking, of course, has been weak economy means rate cuts, means economic stimulus. That means stronger GDP, higher corporate profits, higher stock prices. But perhaps there's a little bit more to this story now. Even though as rule-based investors, I'm sure you will agree that we don't really worry about the Fed as such. We just follow the price. And this week was no different. I also came across kind of a funny, well, at least funny to me, cartoon this week. I'm sure a lot of you saw it. It came from Howard Marks's latest memo, I think it was, that I enjoyed reading. And it was a cartoon of quite an old one, almost 40 years old. And you see this chap watching television on a small screen, watching the news, and the newsreader was saying, on Wall Street today, news of low interest rates send the stock market up. But then expectations that these rates would be inflationary send the market down, until realization that lower rates might stimulate the sluggish economy, push the market back up, before ultimately it went down on fears that an overheated economy would lead to reimposition of higher interest rates. So complete confusion, and I'm sure a lot of investors felt that way after the last couple of days of the week. Now, confusion and somewhat elevated volatility was actually pretty good for the trend followers. I think generally speaking, it was a good week. On our side, it certainly was pretty solid, we saw nice gains, of course, with fixed income coming back to inflate in favor after the Fed decision. Equities losing a bit of ground there, of course. Gold did well, and some of the currencies did okay. We were short sort of the Japanese equities, so they did fine. So all in all, a continuation of what we've seen so far this year. In fact, I got a question, maybe a question I think that may come up later in the show today, but someone just sent me an email saying, with all this uncertainty and everything going on, isn't that causing an issue for trend followers? And of course, the answer is, well, as long as the volatility has some direction to it, it might even be a really good period for trend followers, as we've seen so far this year in 2019. Anyways, that's kind of how we fared this week. Jerry, what about you, and what about some of the things you trade that we don't? How did that all play out?
Well, just to mention that the grains are pretty weak so that was nice to resume that downtrend maybe. Dollar strength in the European currencies and Canada, Aussie, New Zealand. Israel, shekel, that was a strong one. But Mexico, Russia, they kind of sold off a little. So it's a mixed bag in the currencies for us, and amazing strength in the bonds again. Gold had some intraday volatility. I looked, it was down 20 Wednesday, Thursday. Then I think it was finished higher. So I think that looks like a really good trade. Nickel's coming back. I've given up on my long corn position. Silver looks kind of strong. But so a few single stocks did well. I think on some of the bad days, some of my single stocks were hitting new highs, and I was adding to the positions, but that's the way it goes. Thankfully, there is some diversification when you trade the single names.
Absolutely. I mean, that's the interesting part, isn't it? That you see the difference between a week like this week, where all the indices are coming under pressure, but as you said, I mean, some of the single stocks are actually making new highs. So that's pretty good. And of course, we also, I guess, there were some news out. We've been talking about gold for a while. It's been doing fairly well to the upside, and I think there's been a bit of news out this week, or maybe it was the week before, that a lot of the central banks have been buying up huge amounts of gold this year so far, and for whatever reason, maybe they want to diversify a little bit away from the US dollar, who knows, but it's an interesting point. Well, it's also an interesting, sometimes I think, to follow what central banks are doing in the gold market, because as far as I remember, a lot of them sold all their gold pretty much at the low 15, 20 years ago. So maybe this is not a good sign that they're coming back into the markets. Who knows? Before we jump to your tweets, Jerry, let me just quickly mention that we've still got very few spots left for the live event taking place in Manhattan on October 26th, 27th, with some pre-drinks on the Friday, and then full speed ahead Saturday, Sunday. So if you want to grab one of the 5 remaining spots, get in touch as soon as possible, and you can do that by going to toptradersunplugged.com/live. I think it's going to be an amazing 48 hours together, really trying to solve some of your issues, and where you can hopefully shortcut a lot of your own research by getting or some of the experience, at least, we've had in this space. Jerry, tweets this week with all the news flow from the Fed How did that pan out?
I think we had some good things going on this week, some interesting articles that I tweeted. There was one for the Financial Times about artificial intelligence creates strategic dilemmas for traders. And the quote is, hedge funds seek to express successful trading in computer code to get above our emotional attachment to our own conclusions. Unchecked, it could become a slavish deference to the algo, destroying managers' ability to evaluate plans at all. And so I didn't have any room to really write what I wanted to, so I just said, perfect. But unchecked me. Unchecked. Oh my gosh. I don't want to be checked. I want to be unchecked. I want to be forced to slavishly follow my algo and follow my system. So all of us crazy trend followers, we come at it from a different perspective. I did like the idea that to get above our emotional attachment to our own conclusions. Wow, that's good. So many of these topics we talk about week after week, it's like 10 different topics and we just continue to talk about them. But sometimes on these tweets, people are able to word it in a way we've never really thought of before. And this is kind of interesting that we do have our attachments to our conclusions and our way of life, our worldview, but we do kind of know in the end it's probably better for at least us to follow the price.
Yeah, it kind of brings me back to the start of my career back in the mid '80s when I was starting out as a government bond trader. So without rules, without systems. So I can certainly resonate with the fact that it's very easy to fall in love with your own position. It's very easy to fall in love with your own thesis about what's going to happen. And I often hear, podcasts where they discuss investments, where they come up with these expected scenarios and how they position for all of these things. And it's not to take anything away from that. That's their right. That's their opinion. And, sometimes, of course, they're absolutely right. But what I like about some of the people that I follow is that they also always add, but it doesn't really matter what I think. What matters is what the market is telling us. And that's exactly, our point. It's really not that important. Our opinion doesn't play any role in all of this, but we simply just need to, take note of the market action because that's telling us all we need to know.
I like to keep up with AI. I read a lot of the articles, and it's so different than what we do. I don't know if we've talked about this, but what we do is we look at this price and we try to just kind of follow the trends without too many degrees of freedom or too many variables and too many if this then that filters. Whereas AI and big data, they're grabbing all this information and trying to come up with precise ways of is now the time to buy or sell? How many cars are in the parking lot at Walmart? So much different than what we do. This article is kind of funny. It kind of goes on and says, the death knell for human decision-making will sound the first time a court rules a doctor has killed a patient by ignoring the recommendations of an AI-based diagnostic tool. And I, couldn't control myself. So I'm like, or an investment advisor who ignores the system. Which is kind of funny because these, some of the people on Twitter that I don't like as much, they pretty much are convincing people that evidence-based investing, the conclusion is indexing. They may agree with, they may on one show or one tweet say something nice about trend following, agree momentum works, agree that academics have proved momentum has worked. It's the best. But then to go right back to, well, evidence-based means indexing. And I've even used the words kind of like index denier, like global warming denier. Like it's almost like a political thing. If you don't agree with my politics of indexing, then I'm just going to throw you in with the climate change deniers. So you're an indexing denier. So I retweet back like, well, you're a trend follower denier.
Yeah, it kind of reminds me of a discussion which I actually think is quite relevant, but it was brought up by someone that was a colleague of mine when I worked with you, Jerry, back in the day, and this person, I think that's where it originally came from, at least. But going back to this thing about a lot of investing advisors, they have fiduciary duties, right? So their duty is to basically do the best for their clients that they can. And so if all the evidence that we have, all the research suggests that you need to combine uncorrelated investment strategies or asset classes to minimize your risk and maximize your return. Well, we know that one of those asset classes or strategies is trend following. There's no evidence to suggest any other thing. All the white paper since 1983, when John Lindner's paper came out the first time, has confirmed this. So you could take it to the extreme as you did and said, well, so if you don't have trend following in your portfolio, then you're not looking after your clients and fulfilling your fiduciary duty. And you can then turn it around and say, well, because often we hear about people getting into trouble for having, some kind of investment that they probably shouldn't have. It was too risky or too illiquid or whatever. But now we could turn around the argument saying, well, maybe you can get into trouble by not having trend following or managed futures in your portfolio. So I think there's something to it. I mean, I think people have to, to be held accountable for not doing the right thing.
Well, I think in that situation, we're going to end up losing. Somebody asked me, did I really believe in that? And I think that they're asking me, do I really believe that an investment advisor who ignores the system or ignores trend, should they get in trouble? Obviously, no, I don't think that. I think it's silly for at least in our world, as long as the fees are reasonable and there's a little bit of body of evidence. I'm not for a dictator telling us what's acceptable and what's not acceptable and putting it into political terms. Trend following denier or index denier, that's kind of silly. But then another one that I liked was another study that came out that evaluated how few stocks are responsible for all of the gains, the buy and hold strategy. And I think before I had read an article that said 4% of the world's stocks are responsible for all of the gain. Well, this one says 1.3% of the world's public companies account for all of the market gains during the past 3 decades. So I posed the question. I think there's like maybe 3 choices, but probably more. But one is, okay, then own the index. That 1% is in the index. Find the 1%. That sounds like difficult, hard to do. Or use a trend following strategy on your stocks, and then most all the stocks will be profitable. So we've said many times that once you apply trend following to a stock, a bond, a commodity, or currency, a market that has or has not necessarily been profitable from a buy and hold point of view, it miraculously turns into this profitable trade. And so I think that's the strategy that people should adopt is yeah.
But doesn't that raise another question though, Jerry? So if we say that's right, I mean, so out of 100 stocks, very few, 2 or 3 of them are really responsible for all the gains, right? But the challenge with that, if you apply trend following to that, is that we also argue for diversification. So we actually wouldn't allocate the majority of the money to those 2 or 3 stocks. We would allocate maybe to all 100. So we would get a lot of not so sexy stocks when it comes to performance into the portfolio. So how do we deal with that type of issue? Because we don't advocate concentration or few bets with high concentration. So
I was just saying that instead of owning the index or finding the 1% of stocks that do well, trade all the stocks, all 500 or whatever, 30, 40, 100, whatever you choose. And then if you apply trend following on them, I assume a random selection of stocks of 100, you're still going to be in that 1% or 2% range. Whatever your portfolio is, hundreds of stocks, the whole S&P 500 or 30, whatever, trade them all, and then you don't have to worry about, am I going to find the 1%? Because they'll
Right.
all pretty much become profitable.
Yeah, no, that's fine. I misunderstood that. That's fine. I think that makes sense. And the other thing I think to just add to that is that we know in advance and we accept that when you are in a massive bull market, and of course, even with a subset of say an index, we're not going to be able to compete with that, and we're not trying to compete with that. But on the other hand, we're not going to take, we're not going to suffer the same drawdowns and negative performance as these high flyers. I mean, let's not forget one of those high flyers was Facebook, but it did lose 20% in a day not that long ago, and it did go down by 40% following that. And so, one shouldn't always focus on what's done the best in a certain period of time, because everything goes up and down. And what we're trying to do as investors and trend followers is really to create a much more holistic approach, and not shoot for the moon in any 1 week or month or year. We're just trying to get a long term best possible return out of the markets we trade.
And that reminds me of a trade that I had on where, because the other part, or another part of how we do things, is this idea of sizing based on ATR. And if, when you look at the list of best performers, it's going to be primarily percentage wise, which we kind of ignore. And so our list of best performers might be totally different than a traditional list that's just based upon percentage return, because we are going to trade a high volatile stock smaller than a low volatile stock. And I had a stock, CSX, I guess it's trains or whatever, transportation, and it had a very low ATR when I put it on, and it ended up having a profit of 160 ATRs. Now, no one probably had that same return as me, or the traditional way of looking at it would have just been based upon the percentage return. It just happened to break out to new highs a few years ago where it was very, very low volatility. So once again, it's the trend, it's the money management, and of course, we always advocate currencies, commodities, bonds, stocks, long, short. And so we don't live in that world, so we're commenting about other worlds sometime.
We should create like a little jingle that promotes these same themes, because we do say them a lot, but it is so important. And sometimes we all need a little bit of confirmation from the outside to make sure to kind of confirm that we're doing the right thing. And last year was a tough year for those of you who do trend following, without a doubt. This year, it's a pretty good year actually so far. And that's just the way it is. It's like the seasons every year. And until you've been through a few of those seasons, getting a little bit of emotional support, from time to time is pretty good. And actually, I would say the same goes for our clients, especially if they're relatively new to the space, and also because they have to go and defend the strategy when it's not doing well to the investment committee. And so that's exactly what we're here to do. That's what we spend a lot of our time doing. And I think it's a very important part of what we do. People think of us as maybe, but they're just there to press the buttons and make the money. No, I think and I think this goes back to this study we talked about a little while ago, where it had been shown from a study, I think it was Fidelity, looking at their accounts, that the account that had done best was actually the accounts where people had forgotten that they had the investment account with them, meaning that they didn't do anything. They made no changes to their investment, just kept the long run, kept it for the long run. And I think that is so important in our industry as well, especially with something like trend following, that you need to find a way to stay with the track record. When you look at a track record like Jerry's or like Don's, I mean, it's extraordinary the amount of accumulated returns that they have generated. But but I stress that word, cumulative returns, because any 1 year, any 3-year period, can be bad.
That's funny. You bring that up. I think to some degree, the owning an index, which has been the best investment, the stock index, because stocks have done well and it's difficult to beat the index. I think I was talking to a friend and I'm thinking, it's like they're doing nothing. They're really not doing anything. And so I think with long-term trend following, we do a little bit more than nothing, just a little bit more, not too much more, because at least personally, I want to be sort of long-term and hang in there, not get too excited about changing positions or getting out of a good trend. There's so many of them now. The grains have been a downtrend for over a year or two. The bonds, my gosh, depending upon your time frame, you could have been long the boon maybe for 10 years, never got out. And stocks, amazing. There's just seldom is there a time to get really anxious because the markets go up, they go down, we get panicky, we get out only to watch them make new highs or make new lows. And so I think it sounds like a Seinfeld where, what works is doing nothing. But if you let us trend follow your stocks, we'll do a little bit more than nothing, but not too much more than nothing. And, there's a time to pull the trigger. I think something like palladium now had a big uptrend. It's kind of crashing a little bit. So maybe now, you may be more compelled to take some profits in palladium or prevent the drawdown in the palladium from getting crazy and losing a lot of money in the open profit. But so seldom is that the case.
Yeah, I mean, I think for a lot of people, this notion of sitting on your hands is really difficult. Nevertheless, it's super important, and obviously as trend followers, we can also be out of a market for a while, and so doing nothing is also a decision, and sometimes an important decision to take. But I have to say, go.
So no surprise that those Fidelity accounts that did the best were people who were doing nothing, because it's so easy to do harm. Doing nothing is not great, but it's a shame that it's better than most people's activity. That's the lesson. Yeah. I wouldn't say do nothing, but I would say probably better than some of the choices that people make that are emotional and not systematic.
Very true, and of course also this is why we've seen now, I think passive has overtaken active management in terms of the AUM of funds under management, and it is because active management in the mutual fund space at least have not really shown that they're better than the passive funds. Which is partly what we advocate, meaning do nothing. But of course, we want to do active management the way we do it, which is long, short, and with lots of diversification and risk management. So slightly different from what we see in the mutual fund space, of course. What else took place in your Twitter feed this week? I saw.
As I said before, I feel like I'm incredibly qualified to take any article that has nothing to do with trend or markets and turn it into advocacy for trend following. So this particularly good article about people not being able to change their mind based upon science and evidence. And why is that? The article says those with the least understanding of science had the most science-opposed views, but they thought they knew the most. Unskilled and unaware of it. And so I think this was about the medical and medicine and vaccinations and things like that. And it was just saying, like, giving people evidence of proper healthcare or medicine or trend following or investment, it just doesn't tend to work. They harden their views, possibly. And so how do we get people to make the right choices when they don't seem compelled by our wonderful evidence? And so the article goes on to say, it seems important to engage the public more, earn their trust through continued, more personal interaction dropping knowledge from on high doesn't work. And so I know after the show last week, you were sharing with me some of your techniques and how you communicate with your clients. And I was very impressed. And I thought that this is exactly similar to what you were talking about, personal communication. I'm smart, you're not. Here's the knowledge that you need. And if you don't understand it, I'll just give you more. And it doesn't work. You have to meet people's needs, talk to them. They have legitimate concerns. They're probably willing to change if we change. I think that my career has sort of been dominated by this whole crazy mentality of why aren't clients better? Why can't we choose perfect words? Why do our words not change everyone's mind? And I think it's up to us to figure out we're probably not using the right words.
Yeah, no, I mean, it's slightly different, issue than what we normally talk. This has nothing to do with how we trade and how you succeed as a trend follower when we're strictly speaking as performance. But I think that one of the biggest struggles for managers today is really to raise assets, to grow, raise assets from the right kind of investors as well. And I will, since this is more the part of the business that I work with and have done for many years, I would say that this is something that probably only I came to realize, 5 years ago, that the way we as an industry have been communicating, our approach, what we do, why it works, etc., had to completely change, or at least that's what I did. So I appreciate the compliment on that, Jerry, for the things that we talked about. But I think it's important, and I think there's still 98% of the stuff we see out there. It's standard. It's the way we did it 30 years ago. It didn't work then. It doesn't work today. So we need, if you want to be successful as a manager in this industry, I think you really need to think carefully how you, deal on your communication side of the business as well. It's not just and actually what comes out of a lot of these surveys, conversations, etc., is that when investors choose a manager, the performance is not the most important part of their decision process or reason why they choose one manager or another. And I think people would be surprised with some of the points that we hear, at least, as the reason why they choose one manager or the other. And of course, if we look at the AUM of managers, it's quite clear to see that the biggest managers are not necessarily the best performing managers, but they have something else that investors like, and it's very important to be able to identify what that is and to make sure you deliver on that promise as well. Good stuff. We're getting around lots of topics today. Love that. I've got a few good questions, but I want to make sure we get all of the good juice from your social media interactions this week because that always picks up the vibe of what's going on right now. So what else?
I don't know. I like this one from the New York Times again. It's amazing that I can be this old and experienced and still make an incredibly bad decision. It is so easy to avoid the work of determining risk based upon the day's conditions and just pretend that it's fine because it's always been fine. I just feel like I'm always comparing what we do to the S&P, and to some degree I think that once again is what this means to me. Is it's the stocks have been fine, they're great, all of my friends own the stocks. Convince myself that I don't need to worry and diversify more and use a systematic trend approach. So I think, that's what we're advocating. That's what we're saying, that don't look at recent performance or ask yourself the questions of, if the world is really unsafe. And I think to some degree, it's very difficult to have a safe portfolio real time. And I know that crisis alpha and short-term trading and shorter term, the short-term crisis alpha CTAs, They've got to get those trades on. So when the S&P, maybe this is the start, maybe last week was the start of a big sell-off. So my short-term S&P system needs to kick in here and really start making some money. And yet I think that can go either way. We come in every day with massive diversification, longs and shorts. I have short stocks. Even if the indices are at an all-time high, I'm going to have probably a few short stocks and interest rates and currencies and commodities, long and short. So I think it's so difficult to get prepared quickly. It's much better to always be prepared and not to rely upon this system that's going to magically get me in before the S&P crashes, versus on a daily basis, I'm really diversified. I have a proper leverage that I can handle, that I like, with trailing stops and stop losses. And yeah.
Yeah, and you bring up another interesting point, and that is, I think, exactly right, that most of us feel that we are always being compared to the S&P, and of course that's a little bit unfortunate for us in the industry, because the S&P has been by far the best performing stock market in the world for such a long time. I mean, if we were being compared to a lot of other stock indices in the general observations and analysis that investors do, maybe people wouldn't think of us as having underperformed for the last few years. So, but that's just the way it is. And of course, there will be a time when we don't mind. Yeah.
I've had conversations on Twitter. It's kind of frustrating, but so I'll say, well, this index that you're touting, evidence-based low-cost index, stock index, long only, all the time, it has 50+% drawdowns. And you've just said how passive doesn't work, hedge funds don't work, diversification unnecessary because it doesn't help and it doesn't always buffet every single momentary, temporary sell-off. And then the response will be, "Oh, I never would advise anyone to be long indexes only. I mean, but I just got compared to indexes only. Oh no, you do 60-40. You got to have some bonds and real estate in there. Oh, okay. So now can you compare me to that?" So it's just kind of frustrating that the story always changes just a little bit. But I think it's very important for us to have a consistent message, which is trend, systematic, price, long, short. Shorts don't get their due. Shorts are very important. Currencies, commodities, stocks, and bonds. Because at some point, when these drawdowns happen, the proverbial light will come on. Having never been able to see the truth before, down, losing half your money, and everything in your body tells you is incorrect to put yourself in that situation. They're miraculous to be able to see how important everything we've been talking about, and never wavered, even when we got written off and criticized. The diversification was unnecessary, trend, momentum, old school doesn't work. But it's just important to stand up and say, was there anybody telling the truth prior to a big stock sell-off? There needs to be a lot of people standing up and saying yes.
Yeah, and if they don't believe us as trend followers, even big investors, which get a lot more press than we do, like Ray Dalio, I mean, he's out there, he's advocating for finding, uncorrelated return streams, et cetera, combining that, et cetera. So you would be surprised if, at least on the professional side of things, that investors wouldn't have had ample time after such a long bull run to get their portfolios, in the right shape. And not because I consider us as being any kind of insurance, because we're not. We're just an uncorrelated return stream. But if you think of it as something that could potentially help your portfolio during a tough time in equities, so let's just call it an insurance in that situation, you wouldn't want to buy that insurance after the event. You don't buy, house insurance after your house burns down. You buy it before. You make sure you're prepared. And why would investments and taking care of your family and your, the money you've saved up, why would that be anything less important than that? And that still surprises me when you see the headlines and when you see the big flows into trend followers and CTAs after a crisis. Everybody seems, but we should have had more of this. Why not do it before you need it? And of course, this year, this is the funny thing. There is no crisis per se in the markets, yet it is a fantastic year so far for the industry. I think the trend index, the CTA trend index, is having its best start to the year. Maybe at the moment it's having the best year so far if the year ended here, which is also why we talked many times that this label crisis alpha, in my opinion, is not helping us. So it's a good reminder, like we saw in 2014 and to some extent in 2017, that we don't need a crisis to make money. We just need trends, and when they're there, we're pretty good at capturing them because we are prepared at all times, as Jerry just said. We're not waiting around to suddenly realize, but we need to trade this and that and this and that. We've been doing it for decades, but we accept that it doesn't work all the time.
Yeah, and I had another Twitter conversation about buying puts. And buying puts are expensive, or trading a short-term system that might get you short S&Ps in quantities that's going to matter. May not work all the time. Not only with our diversification do we offer the diversification, and it makes the portfolio volatility a lot lower. There's no opportunity cost. We make money. There's so many of the ways of protecting yourself and buying insurance. This is insurance that actually gives you back the premium. So
and some.
Yeah. So it's historically better than trading just stocks if you go back far enough. So not the past 10 years maybe, but a little bit further.
That's a great episode on AQR's podcast a couple of weeks back, maybe 3 weeks by now, on the Curious Investor, their podcast, which is great, very informative, entertaining, and all that good stuff. Called To Diversify or to Hedge, and they go right into this topic. How do you compare people who just want to hedge? So the cost of buying puts all the time, for example, because I think some people still feel that is a better way or a cheaper way to do that. But the reality is you can lose a lot of money if you follow one of those strategies. I think they came up with something, and this is a little bit from memory, but I think directionally I'm right on this one. That the index, because there's a put index or an options index that does something like this, where they buy 5% out of the money puts every month, and they've been running that index for a while, and I think it's underperformed the S&P by several percent, 4 or 5% per year for 20, 30 years, and I think we can all work the math out that is a devastating underperformance in such a, over the long run. So you would have had very little to show for compared with the index. We don't advocate looking at what we do as a hedge, but as something that can certainly help when you most need it.
Oh, yeah, I've said before, when I got a marketing email from a friend about his fund, he called it the perfect hedge. And I immediately responded, "What are you doing?" He says, "Oh, God, you're right. Thanks for calling me out." And I was like, "Yeah, dude, it's the perfect portfolio, not the perfect hedge. And the perfect portfolio is going to underperform the best part of that portfolio sometimes."
And of course, it doesn't help that the much bigger industry that we're in is called the hedge fund industry. And I think people unfortunately think that means that all these funds are hedged. But as we've seen many times, that's not the case. Are you ready for some questions, or do you have more
I'm ready
Twitter.
I'm ready for some good questions.
Okay, I think we've got some good ones. We've got questions from Sandeep, James, Dante, and Ali, as far as I can tell, quickly running it down. So let me start with Sandeep here. He says, I would like to really appreciate all of the help and support you are providing for the people like me who has no resources or chances to learn and understand from the professionals. I would like to know which markets are correlated or any material where I can get more details on market correlation between metals, soft energy, grains, meats, indices, and rates. I would really appreciate your comments on this topic, and thanks again for all your help and support. So let me just jump in on this one first, Sandeep. So since you understand the point or the concept of correlation, you can't really say which markets are uncorrelated, which markets are correlated, because these things change. So they won't be having the same correlation to each other all the time. So what you really need to do is to go and, and I think that you can probably get that for free from the internet. You need to go back and get some historical data on some of the markets within the sectors that you mentioned. And then you need to do your own correlation analysis, in my opinion, so that you can see how they behave with each other over time, but also how they behave in shorter periods of time in terms of correlation. Now, from our point of view, we, of course, are aware of this correlation, but we don't know what the future correlation will be. Nobody knows. So sometimes you can also just think of it as common sense. I mean, if you want to build a portfolio of, say, 25, 30 markets, you've got your historical data. You can see what the correlation has been historically. But you can also kind of make a little bit of a common sense judgment. I mean, what's the likelihood of lean hogs and the Australian dollar suddenly becoming highly correlated market? Probably not very high, and things like that. So you put together a portfolio of markets that represent the various sectors that you mentioned, because it makes common sense. So, and then also that also means you should avoid too much concentration in for example, interest rate. I mean, interest rates have become much more correlated these days than they were 20, 30 years ago because of coordinated central bank policies, etc., etc. So just use common sense, but go and check the data, do your research. Not only will it help you, you're also going to learn a lot from doing it.
I agree with all of that. I think using a spreadsheet or program, portfolio visualizer.com, I think that helps. You can see, what does that mean, though? Silver and gold are kind of correlated. What am I going to do with that information? So am I going to just ignore it? Because gold is much stronger than silver, and silver and gold have taken vastly different paths a few times historically, and then they go back to being 90% correlated. I can't tell you what to do with that situation. I do know that it's not just the correlation of the markets, but then overlay trend following. So that reduces the correlation. Sometimes, for instance, wheat was very strong earlier this year, but Kansas City wheat and Minneapolis wheat were not. So maybe the wheat, you got run out of your shorts, maybe you got long. The other two, no. But they're probably 80% correlated. What are you going to do? It's difficult. There's no, I don't know the answer. I don't know what to tell each individual person in that regard. But I do think it's important to look at the correlations and not just trade markets because they're there. If there's a future on it, I'm going to trade it. Come on, seriously? I think when you get into stocks and you sort of see that there's a 1,000 possible stocks that you could trade, I got to make some choices here. And then I say to myself, should I be making choices on some of these futures as well? Crude and Brent? Yeah, you probably should. period. I'm just going to stop there because I don't really have a good answer, except it's a dilemma and figure it out for yourself.
Yeah, no, absolutely. And thanks for your question and for your interaction with us. Next question is from James. James starts by saying, very good podcast this week. Really enjoyed it. So that's obviously a reference to last week's episode. If you missed it, then maybe you should go back and listen to it. He says, had a quick query when adding new instruments to the stable. Say something like Bitcoin. Is it imperative that returns derived from a certain set of signals on the new instrument are standardized into units of volatility in order to make appropriate comparison in terms of trade stats, i.e. average win? I appreciate one would want to do this in a portfolio construction phase. So we don't trade Bitcoin, so maybe I'll throw that back to you, Jerry. But in the initial stages, I guess, is what James is asking for. When you look at the returns, etc., what are you looking for before deciding whether you should add Bitcoin to your stable?
Oh, I'm ignoring the historical returns. I'm just looking at the diversification. Is it worth adding? Is it different? Obviously, Bitcoin is so different. That's the one thing everybody can agree on. It's different.
Yeah.
So I'm going to ignore the historical performance, which is very short. I certainly have markets in my portfolio that have not made money ever or in a long, long time. I don't think from a systematic trend point of view, backtest point of view, that's relevant. You want to include it because all the trades are the same. They're all traded the same way. On and on. The thing we keep repeating over and over, that it doesn't matter what any individual market stat is. I like looking at the average trade stats on all the markets, but I try to ignore them and just look at the average for all the markets and say, that's my trade expectation or win percentage. I'm not going to optimize on a market by market. It doesn't mean anything.
Sure. James continues with a second query. He says, second query was about price signal strength. Could you point me in the direction of any materials that would give me some details on how to calculate the price strength? There was a chap on Macro Voices, Charlie McElliott, great podcast, by the way, who a few months back has previously referred to his models having load factors in order to determine the allocation across various look-back periods based upon the strength of the price signal in the set window and most probable realized volatility. So when I read this question the first time, I was unsure, James, whether you meant how do we calculate the signal strength or the strength of the market itself. I'm not entirely sure. But what I can tell you is when I think about signal strength, as you know, we don't use just one time frame. We don't use just one, set of volatilities to calculate the breakout or something like that. So we have a lot of combinations that we put together in the model, so we get multiple entry points, multiple exit points. So when I think of trend strength, let's just imagine that we had, 100 different combinations that would all have to trigger, say, in the same direction, let's say long, in order for us to be fully long. So when I think of signal strength, I think of how big a percentage of these parameter combinations are heading in the same direction. So if 80% of them are saying long, and we're therefore 80% long, let's say the other ones were neutral, then that to me is the signal strength. Then that's a pretty strong trend because we have lots of confirmations that we should be long this case. If you're asking for ways to identify whether the market is strong, well, to me, that actually is a way of identifying that the market is in a strong trend, because otherwise all of these signals wouldn't have been triggered in the first place. So I wasn't entirely sure if this is what you meant. If it's not, send me an email if I'm wrong. I have listened to Charlie McElliott on various podcasts from time to time. he is, of course, someone who has kind of made a name for himself by talking about, he works for Nomura, I believe, and he's not a trend follower per se, but he has developed some systems that does or shows what trend followers are likely to do. And he talks about that, and he talks about certain levels where he thinks if that happens, then all the CTAs are going to be selling or they're going to be buying. Now, I have a lot of respect for him, of course. I'm not trying to make fun of it, but I think it's a little bit too simplistic. It doesn't really work that way in the real world, in my opinion. It's not like we flip our positions based on one price or whatever. It's time and price and sometimes even volatility. So it's a little bit more complex than I think sometimes what it comes across as. But again, I don't want to criticize. I just want to say I think I have a different opinion about it. Yeah, I think that's probably all I need to say.
Yeah, we looked at some of his ideas, and we couldn't. I think the three of us didn't know anybody who traded like that, and so yeah. But okay, so
but it's a good story, and this is why he's become so popular, right? It's a great story to go out and say, oh, but I think at 28.50, all the CTAs will be only 25% long. I mean, it sounds great. It gets a lot of media attention. And it actually also is why trend following is not always well understood by people, because they believe, someone who gets front page cover of Bloomberg, but it's just not what we do as professionals.
Yeah, I think Marco, he gets it. He's done a pretty good job of identifying risky periods that CTAs probably were involved with. So I do like Marco. I think J.P. Morgan. But so I took this question a little bit different, and because I too I'm a little confused. But so I think that this I took it more as a relative strength. So how can you tell me that I should emphasize gold more than silver? And and I think that that's sort of something that I wouldn't do. If silver met your entry criteria, the breakout, the moving average, the low vol, whatever your entry criteria is, and then gold met it, then buy a little bit of both. So, but gold seems much stronger by some sort of relative strength or stochastics or something. Shouldn't I, this time, buy more gold? And I would say no, because you don't want to do a this time thing. You want to buy a unit of gold every single time it hits your entry criteria, buy a unit of gold, a silver, every time it hits your entry criteria. And it's, and so that's it. You're done. It may look right now that, gold is stronger or silver is weaker, but silver can catch up, and you're kind of blowing up your sample size and the need to be disciplined and follow the system every single time for the rest of your life. So I think once it meets the entry criteria, you're long or you're short in all the markets. I don't think I like the idea of let's trade some of them larger than others. Now, larger because they're less correlated. Like I think I trade canola larger than soybeans because I have soybeans, bean oil, and bean meal, and I trade each one of those individually smaller than canola, which is not correlated to anything, not correlated to those three, for instance. And that's a permanent idea. Bitcoin, I'm going to trade that larger. It's not correlated to anything. Cotton, not correlated to anything. But consistency, got to be consistent and not no relative strength.
Right, and I think also, you bring up another good point, which is, I think as if you're too close to the, one of the benefits, of course, of doing what we do is that we don't have to sit and look at the screen all day. But I think if you did, and you constantly were following the news flow to find the right trade and get in and out and all of that, I think you very often would be asking yourself, is this time different? I think this question where people always think things are different this time for whatever reason, and therefore I should do something different. is really, really dangerous when it comes to investing. And so, one of the key advantages, maybe you have some of that in your portfolio. Maybe you have some other types of managers. Maybe you do it yourself. But one thing that we offer as an industry and as trend following managers, having done this for a long time, we offer a diversification also in terms of investment process. And we don't talk a lot about that, actually. We talk about it in different ways, but we often talk about, but the correlation is low, it's 0.5 to whatever, and it's whatever. But deep down, what you really get from including a trend follower in your portfolio, if you're not doing it yourself, is this different investment process that probably very few people do, because there aren't that many pure trend followers anymore. And I think that's super valuable in your portfolio. I think it should be the rock of your portfolio. This is where it starts. Most people don't see it that way, but I think it's incredibly important. All right, let's jump to the next question, unless you wanted to add something.
No.
Oh, cool. So this question is from Dante. Dante says, "Hey Niels, just listened to this episode. I really love the Rabbi Mahoney example because I found that speaking things to existence really works." What he's referring to is my conversation with Professor Andrew Lowe, someone that I really love because of his great way of explaining behavioral finance, and of course he's also a trend follower in addition to being a esteemed professor at MIT. So that's where that Rabbi Mahoney example came from. And if you don't know, if you want to listen to what it really means, and I think you probably should, then it's on the latest episode of Best of Top Traders Unplugged, or you can go and get the full interview with Andrew Lowe. Anyway, back to the question from Dante. I had a question. Recently, because of how geopolitics and central banks have been involved, there has been an increase in volatility and unpredictability, which makes it hard for trend followers. What strategy do I use in these periods? Now, Dante, I know you told me you're sort of starting your journey after college, etc., etc. But I think you bring up a good question that I want to respond to, which, of course, I already did in writing, but I want to do it also so other people can hear it, because they may, have a similar thought. So when trend following doesn't work, what strategy should I use in the meantime? And of course, the answer is you shouldn't use any other strategy in the meantime, because we don't know when trend following will work, and we don't know when it won't work. So the point here is to accept that it doesn't work all the time, and make sure that when you design your system that you can withstand the drawdowns, that you don't get nervous, etc., etc. You have to learn to love your system, which is one of Jerry's slogans, which is so important to embrace fully. And so trend following is a holistic investment approach. So important to, and by the way, and I think we touched on this in the beginning of the conversation today, because I was thinking back of your email. And the point is that even though there's been a lot of geopolitical uncertainty, and we don't know what the next tweet will say, and we don't know if the Fed is going to do another pivot this year or whatever is going to happen, the point is that this year has been a really good year for trend followers. So even if we have volatility, even if we have uncertainty, as long as that is channeled through some kind of directional moves in the markets, we don't mind this at all. And our risk management will take care of the increased volatility. Our positions are going to be slowly, reduced when we get new signals, because the volatility is bigger, and all of that good stuff. So that's part of your risk management, and that's why it's some. And I think a lot of people actually misunderstand that, because I've certainly heard from investors on my side here is that sometimes they would say, well, say commodities, that seems more risky than some of the other stuff you do. And the answer, of course, is no, because we size the position based on the volatility, the inverse of the volatility. So we don't take more risk in commodities as we do in fixed income or in currencies or in stocks. So another important part. There's a couple of more good questions coming, Jerry. Do you want to add anything else to Dante's comments about this?
No, that was good.
Okay, cool. All right, so we are back with the last questions here. Quite a few of them. Let's see how many we get through today. I know you've got a backstop on time today, Jerry. This is from Ali. He says, thank you for your podcast. You are providing a wealth of high quality information to the trading community, wrapped in a delightful conversation. I'm a long-term listener of your podcast. I usually binge 2-3 episodes together. I highly respect all of you and admire what you're doing. Thank you very much, Ali, for the kind words. Okay, here are some of the questions. I heard you were answering a question from a listener a while ago with Moritz about the optimum number of systems to combine in a portfolio. I actually would like to point you to some research done by Dalio about the subject, and it turns out that the optimal number is 24 to 28 systems of zero correlated returns, etc., etc., etc. So, Dante, that's actually kind of what I was referring to earlier in the conversation, where Dalio has, I actually thought it was a little bit low, but it doesn't really matter. The idea is that, yes, if you combine uncorrelated return streams like we do inside trend following, it certainly increases the return and reduces the risk and all of that good stuff. So that's a great resource. But now your specific questions. You mentioned that you trade, that's us at Don, 55 markets. And Jerry mentioned that he trades about 75 markets. And here's the question. Do you pick the market based on correlations, e.g. Trade oil, but don't trade heating oil? Do you pick one market from a sector, say energy, based on the momentum of a certain period? Or do you trade all signals in all markets, or have some other method? Now, of course, this particular questions we kind of had just earlier today, so I'm sure you heard our conversation about that. I'll let Jerry summarize what he does, but on our side, Ali, yes, we basically pick a few markets from each sector. We haven't really made changes to those markets in a long time. They are the classical trend following markets that people started out with many years ago. But we treat all of them equal. So maybe that's where we're a little bit different from others. Jerry mentioned earlier today that he might treat some more in a block and trade them smaller compared to others. We don't. We just trade the same. But there's no wrong or right in that sense. You should do what feel comfortable based on your results. So that's how we do it. And so we treat them individually, and that means we take all the signals within our risk budget, of course. But that's how we do it on our side. So, Jerry, if you want to add anything on your side.
Yeah, that's right. You get a choice. I think, if you want to trade all three of the energy markets, then I would, trade them a little smaller than something the risk I would give in cotton or cocoa or coffee, because they're kind of the same or similar most of the time, almost all the time. Natural gas is different than those three. So you got a choice: crude only, or a little bit of crude, heating oil, unleaded. So there's diversification in trading all three, but I would do it a little smaller, or materially smaller than if those three weren't correlated. So the total equals about the same. So I do think I wanted to comment on the number of drivers, the 28 drivers. I think there's maybe I'm confused, but I think it is kind of confusing in that, we trade. You trade 50 markets or whatever. We trade 70 or to 100 because we trade some stocks. And, I would say those are drivers. Cocoa's a driver, mm-hmm. Cotton's a driver. Someone else could say managed futures is a driver. Diversified trend following is one thing. Stocks are one thing. International stocks, bonds, buy and hold on a lot of things. Real estate is one thing. Bitcoin can be one thing. So it's just a way that everybody has their own opinion, a way of looking at things. Trend following has lots of drivers, way more than 28. But I think what's the most important thing that's driving everyone these days is, why should I do anything other than stocks since they've been so good, and it's probably going to continue, and that's what we're saying. don't be so fast. It may not continue, and it is one market, and there's not much diversification.
Yeah, good. Next question is really for you, Jerry. Alec goes on to say, Jerry trades stocks. I'm assuming it's single stock futures. You might want to comment on that. Anyways, and then the questions, are all stocks considered one position in the portfolio, question mark, or each stock is considered as another market? What is the percentage of portfolio risk allocated to this market? When many signals are triggered in this market, single stock futures, and you are limited in the number of positions to take, how do you decide on which one to take? Is it the momentum, the trading volume, ATR? It's a little bit of everything here.
Oh, wow. Well, I'm going to set up my risk budget so I can take all the trades as they come. I need to do them all. So I don't think that there's any difference between saying, I can't afford to do this trade, so I'm not going to take it, or what something everyone knows is wrong. I don't want to take this trade. I've had 5 losses in the same market in a row. It's the same thing. You're not doing the trade, whether it's money management, no matter what you call it. I'm weak. I don't want to do the trade. Or it's money management. I can't afford to do the trade. So I like to set my risk budget up to where I can afford to do all the trades as they come. I forgot the first question. What was that?
That was about whether you trade single stock futures or single stocks.
Yes. Well, I trade single stocks now. A little bit of both, but mostly single stocks. And I remember listening to you early on, Niels, and you were, I forgot how you worded it, but I took it that you don't like to look at, Dunn doesn't look at sectors so much, and this sector and that sector. And I think and I like that. And I got to thinking about that, and I was thinking, I don't want to have a stock sector that I need to fill up. I don't want to have a commodity sector that I need to fill. I just want to start adding markets to the portfolio that are relatively uncorrelated and gives me some real diversification. So if I can't find enough stocks that are different, Tesla, Beyond, Canopy Growth, Uber, if I can't find enough different crazy stocks out there, if I can only find 5 or 10, then I'll stop right there. I'll trade the currencies to the degree that they add value, but why trade the Swiss and the euro, or the euro and Swedish? It's kind of similar. So I think that's the attitude you want to have. I do trade the euro and the Swedish, but I'm just saying for illustration purposes, I like to get into this mentality that I'm going to add a market if it's going to reduce my risk and make my standard deviation lower. And I don't want to have to think, well, I've got to trade bonds. I've got to trade all the bonds. They're there. All my competitors are trading them. No, I'm not going to do that. I'm not going to fill up a stock sector or a commodity sector or a currency sector. This is something I think we need to move away from and concentrate on the perfect portfolio, which may not include every single futures market, but I would suggest include them to the extent that it actually helps.
Yeah, no, very, very good. Yeah, makes sense. Very good point. Ali goes on to ask a question here, which I don't know if we can answer it, Ali. I personally, I can't, but I'm going to see if Jerry can. Ali goes on to say he has an account with TradeStation and Interactive Brokers, but he also hears mention markets that are not available on these two platforms, and then whether we know of a reputable broker that have all these markets and cover markets that are not offered by Interactive Brokers, etc., etc. I mean, for my part, I don't know specific trading platforms, so I can't really tell. Maybe you want to venture into this, Jerry, or not? I mean. No. We unfortunately can't help really on that because we don't know necessarily what people, and we don't want to give away necessarily a recommendation for a broker that may turn out not to be a good fit anyway. So just do your research. I mean, it's easy to find on the internet. Speak to them, figure out what they're doing, and it shouldn't be hard to narrow down people who offer all of the markets you need. Sorry about that. Margin to equity versus position sizing, the last set of questions for this week. If I have 1 million and I put on 50 positions, 25 long, 25 short, in uncorrelated market, each with initial risk of 0.5% of initial capital. If they all lose the projected initial risk, theoretically, then the account will be down 25%. In the above scenario, I'm doing everything by the book to limit the risk of the portfolio. If I limit margin to equity to max 30%, and if after putting 20 positions on, I reach the maximum, does that mean I can't add more positions, even if by design I'm adding more diversity, time frame, direction, market, and thus less risk in total? With the above in mind, where does margin to equity fit in the portfolio assembly pyramid? Is it before or after position sizing, or does it replace position sizing? So lots of questions in that one.
I would just say that two things. I would not use margin as a risk metric. I mean, if my margin was 75%, I would know something was up, but it's the ATR for each market. And I don't think as a general rule, we all need to have money management rules and max risk that we can have on. I always have a lot of unused capacity because I already said I make sure I have this unused capacity in case every market has a position. I've never seen it happen. It could happen. But I would say that under no circumstances should one exceed their risk budget that they've carefully constructed with the excuse that, but it's adding diversification. Don't do that. That's not safe.
Yeah, no, very important. And also I would say here, Ali, that keep in mind that even if you put on 25 longs and 25 shorts, and even if they theoretically lose, all of them, and you're down 25%, you have to keep in mind that they could keep on doing this. I mean, there's no rule saying that they can't keep losing money. I mean, of course, it's unlikely they're going to lose all of them are going to lose money continuously, but you always have to think that a particular market can give you 10, 15 false signals before it gives you a good signal. So it's the only way to really know how to size your position, whether it's 25 basis points risk or whether it's 50 basis points, once you've selected the markets, etc., is to run some simulations, really, to see how, what is possible in terms of risk. And then you probably need to add to that, because a backtest will never give you enough downside, in my opinion. There's always going to be more downside in the future at some point. So be careful with that. Get your diversification, make sure your trade size is small enough so that you can go through these drawdowns. And I completely agree with Jerry. Margin to equity is just a visual of the risk you're running. It shouldn't be your risk management tool. So we probably have to cut it there, Ali, because we have a little bit of a time constraint today on our side. But we do appreciate all your questions. Let me quickly run through the performance so far. This is as of Thursday. I think Friday was most likely a positive day, even though confusing for many investors. So anyways, the Beta 50 index is as of Thursday, so the 1st of August, only one day of trading, up 39 bips for the month already and up 8.86 for the year. SocGen trend up 30 bips for the month, up 8.82 for the year. The trend index is roaring away, up 65 basis points, up 13.37 for the year. And the SocGen short-term traders index up 30 bips for the month, or for the day, I should say, it's the same, and up 1.52% for the year. The Bridge Alternatives had no data for August 1, so I can't update that, but it was up 9.10% at the end of July. Before we go, anything you want to add, Jerry, or so we thought we were going to talk about, which we didn't?
No, it's we're doing some heavy lifting without Moritz, so I'm happy to get him back next week, hopefully.
Yeah, he needs to come and do his part. So, anyways, we, as mentioned early on, we now have this new feature. We don't know if it works, but you can try it out. We hope you will. If you say something nice, by the way. It's toptradersunplugged.com/voicemail, where you can leave a message. Probably for now, don't leave any specific questions, because I don't think we can necessarily play them and then answer them straight away. We can when I'm back in my office, but right now when I'm traveling, not so easy for me to do, but we can play some of them when we mix the audio. So that could be fun if you've got some feedback or comments that you want to share with us and all our listeners. I don't know how many we will do every week, but the best one. So of course, you can leave a review if you want to help us out. toptradersunplugged.com/review. And of course, Jerry and I and Moritz, we do appreciate you taking time out of your busy day to stick around for another episode. And we very much look forward to being back next week. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor Podcast Series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode.